Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp, and it's great to have you with us this morning. It's graduation weekend in Chapel Hill. What kind of job market will the graduates be looking at when they head out? Greg Brown, who is a research fellow and also the former executive director of the Kenan Institute, will be with us in a moment to talk about the employment situation, especially given this morning's report from the Bureau of Labor Statistics. He'll update you on that, have some analysis. He'll give a presentation of about 15 to 20 minutes, and then he's going to take your questions. If you have a question for Greg, please enter it using the Q&A function at the bottom of your Zoom screen. You may find it in the More category with the three little dots. Check in there if you need to. Go ahead and submit those questions anytime during the briefing, and we will do our best to get to them. If you are with the media, please include the name of your organization so that we can know to prioritize your question. If you're joining us by phone today, you can ask a question too. You can email it to me at rob_knapp at kenan-flagler.unc.edu. I'll keep a lookout for those. We intend to go about 30 minutes here, so we'll take it to 9:30 and see where we go, always trying to answer as many of your questions as we can. So let's move on to the main course here. With us today is Greg Brown. He was our executive director here at the Kenan Institute for a long time, and he is a research fellow as well as a lot of things over at UNC Kenan-Flagler Business School. Good morning, Greg. Good to see you.
Hey, Rob. Thanks for the intro. Um, Go ahead and start sharing my screen here so we can look at the slide deck. Hopefully that's visible to you all now. Um, yeah, so another interesting employment report. I think we should start out by recognizing the fact that someone should pay me to do these briefings every month because it seems like whenever I do the briefings, it's a positive surprise and good employment outcome. And we had another good April print here, so the expectation was for about 65,000 jobs. That's been sort of roughly the average that we've seen the last 6 months or so. And we actually came in at 115,000, and we got a little bit of a upward revision to March as well, and it was also pretty strong numbers, stronger than we saw in April. And in fact, this is the first time we've had sort of back-to-back positive changes in non-farm payrolls for almost a year or so. So in that sense, I guess, it's sort of a positive surprise, and also, finally maybe a little bit of consistency instead of this bouncing around back and forth that we've seen. Um, inside of that, manufacturing was essentially still flat, down slightly, but that's basically zero. There's, I think, some questions around, what's happening with manufacturing right now. We can dig into that a little bit more later. Average hourly earnings came in just sort of slightly weaker than expected, but sort of, consistent with what numbers we've seen over the last year. I've got more detail on that in a minute as well. And average weekly hours came out just a tick stronger than expected. Unemployment rate held steady. Labor force participation dipped down some. And another thing that we'll talk about a little bit more. So at the risk of sort of getting too granular too quick, here is the sort of time series of changes in employment that we've seen over the last 5 years, and you can see, I mean, we've been coming off this really strong, kind of post-COVID rebound in the jobs market, just super strong as kind of people went back to work as the pandemic ended. Things sort of normalized there, and then we got into this kind of rough patch over the last year, where, as I mentioned, things have been, bouncing around. We've had sort of basically zero net job growth for the latter half of 2025. things have been a little bit better here, in 20, on balance, in 2026. But again, these last 2 months are the first two that we've had sort of like back-to-back gains in quite some time, going back to the beginning of last year. So, hate to extrapolate too much from, just two data points, but from a broader economic perspective, it is sort of nice that we're seeing what looks like stabilization around positive numbers in employment. All right, now why are we seeing all this bouncing around? Again, like this is kind of a nitty-gritty technical thing, but the way that this employment data is collected is through businesses submitting their monthly payroll information. And so the data is sort of subject to the whims of businesses reporting. They historically have done quite a good job of reporting eventually, in the within 2 or 3 months afterwards. But there has been a notable drop since COVID, in terms of the percentage of folks that are percentage of companies, to be precise, that are reporting on this first release, the data that we're looking at today, for April. And it's improved a little bit in the last few months, but it's still below where it was uh, you know 10 years ago, for example. And so this has caused some people to wonder, some of this volatility that we're seeing in these monthly numbers, the result of just sort of incomplete data, and then things normalize a little bit after we get more complete data. That's a possibility, and it would sort of suggest that we'd see larger revisions. It doesn't really explain the fact that we've seen things bouncing around even with the revised, more complete data. But it's something to sort of keep in mind when you're looking at this first employment print, that it is sort of subject to revision. Um, when we look at sort of these measures of what's happening at the household level as compared to what's happening at the sort of corporate, payroll level, the establishment level, as they call it, there's a little bit of a nuance here. Unemployment rate is held steady. The one that's the headline rate around 4.3%. That's a good level. I mean, that's something that's consistent with the perception of what full employment is in the U.S. economy. But there's some subtleties to this. We have seen a little bit more of an increase in this broader measure of unemployment that includes people so-called marginally attached to the labor force and working part-time for economic reasons, in the sense they couldn't necessarily find full-time work even though they wanted it. It's still a good level. Like that 8% number is still a good level, but it is a bit more of an increase than what we've seen in the headline rate. And interestingly, part of what's going on here is that although we've had weak employment growth in the establishment survey, the unemployment rate has held steady because we've had people falling out of the labor force. And if you actually go and look at the number of employed people in the household survey, where they actually call up, households, or they contacting people directly to figure out what their employment status is, we've actually seen a decline in employment over the last year. And there's sort of various theories around why this might be the case. Part of it might be that they don't ask people's immigration status when they do that, and so we see a larger decline in employment when we look at asking people if they're employed or not, because people who are undocumented immigrants might have a different response. Might be recorded differently than people in the payroll survey. So a little bit of a mystery in terms of what's going on there. But it's certainly the case that when you look at some of these labor force participation numbers, that we've seen decline. So I just picked one here. This is people who are 55 years old and or older, and this participation rate was very steady leading up until the COVID. There was a lot of people that came out of the labor force then, retired, or didn't want to continue working during the pandemic. That sort of stabilized at the level, kind of post-pandemic level there. But then recently we've seen that number drop off again. So, there's kind of like various moving pieces here to try to understand, why is it that we've seen stable unemployment rate, even though on balance the last year has seen essentially zero net job growth from the establishment survey, businesses reporting employment, and a decline in employment as measured by household responses. So we can kind of dig into that a little bit more. Another explanation relates to the types of businesses. You know, the ADP, which is a private payroll service company, they have their own measure of employment that they report, and they give us data in terms of the size of the business. Large business, more than 500 employees; medium, 50 to 500 employees; and then small, less than 50. And what we see here is that, again, these numbers have been sort of choppy. They're always choppy, but over the last 6 months or so, there's been a lot more variation in the employment by small businesses than by medium and large businesses. So maybe something going on there. Again, not totally sure what would be driving that. There's different theories, but to the extent that we might think of small businesses as being not as resilient, not as able to weather particular shocks, whether it's sort of policy shocks, stuff related to energy prices, things related to immigration policy, then that volatility might be something we pay close attention to. The other big thing people have been looking at recently is the tech sector. So we know the tech sector has been retrenching, sort of the traditional tech sector. And after what was probably some overhiring during the 2021, 2022 period. And in fact, we've seen net declines in employment in the tech sector pretty consistently over the last year. But it's not just that job loss on average. It's also been quite volatile, and so some of the volatility that we've seen is likely also due to variation in tech employment. But in some ways, this sort of begs the bigger question, which is around AI and what is the impact of AI on employment? And some commentators suggesting that we may be at the very front end of what could be fairly significant restructuring of the labor market related to corporate adoption of AI. And the canary in the coal mine there probably is the tech sector, because one of the things AI is great at is coding. And so when you look at the demand for software engineers, for example, it's likely to be negatively affected by AI. And potentially we're starting to see broader impact as well. Things that we think of as high productivity jobs, which are classified as professional and business services to a large degree. Like that employment, kind of roared out of the pandemic recovery to new highs around 2022, and then has been in sort of a fairly slow, steady decline. A little bit of an uptick over the last 6 months or so, but still below the peak that we saw a few years ago. Some of this might have just been good old-fashioned cyclical overhiring, but there's also indication that there could be AI making inroads into especially more entry-level type of positions, where new hiring has been reduced because of the effects of AI. And I mean, we're particularly sensitive to that here at the university because we're trying to put people into entry-level jobs when they graduate. And for sure, we have seen that it has been a tougher job market over the last few years. And it's hard to quantify it, but at least anecdotally, we're hearing from folks that they're reducing the size of their incoming recruiting classes because they're finding ways to essentially replace entry-level employees with AI tools. So, something to kind of keep an eye on is potentially a long-term trend, but also what could have, been a partial explanation for the choppiness and relatively low employment levels we've seen over the last year. Um, okay, so maybe that's bad news. We can start talking about maybe some more positive things. We continue to see temporary help employment stabilize. Now, that is a good thing. So when temporary help increases, that's a sign of tightness in the labor market, people wanting to expand, having a hard time getting full-time employees, ramping up. Uh, Temporary help is a way to kind of bridge the gap. And then we saw this big decline after that peak. And so, that was not a great thing, but this fact that it's sort of stabilized here, that's a bullish indicator. That sort of suggests stability in the labor market. And so, again, thought of as a leading indicator, and the fact that we have seen this stabilization around sort of a long run average and temporary help services, I think is a generally bullish indicator. Um, so how does this sort of translate into broader economic things we care about, and in particular things like monetary policy. We can say a little bit about fiscal policy as well, but let's start in terms of what the implications might be for monetary policy. Uh, so wage growth is pretty stable. Um, it's in the sort of 3.5% range. That's the average hourly earnings data. Um, the CPI inflation data has, sort of, I'm going to say sort of stabilized. That we have seen a bit of an uptick because of energy prices in particular. But I think it isn't just the stabilization that matters, it's where they stabilize that matters. I mean, we want high wages, but only if high wages come along with high productivity growth. There's some signs that productivity growth has been good. But the stabilization of CPI in the 2.5% range, maybe higher now with higher energy prices. That's a rate that is above the Fed target and may worry the Fed. And when you zoom in a little bit more and look at core inflation, so this excludes food and energy prices, and this is the measure that comes from com personal consumption expenditures, so the so-called core PCE deflator. This is the Fed's favorite measure of inflation. We're definitely seeing an uptick in that. And here the three lines are just sort of the look back period. So the most recent kind of 3 month rolling inflation is now up above 4% again. If you look at a bit of a longer horizon, it smooths things out. So you're under 4%, but well north of 3% at the 6 month, and then year over year, just a tad over 3%. I mean, those are numbers that are definitely higher than what the Fed likes. And again, this is the Fed's preferred indicator. So it sort of raises this question. What's a Fed do? We're going to have a bit of a new regime here in Fed policy with the new chair, um, uh, Kevin Walsh, but he's just again one vote, historically a very influential vote. But I don't know. The Fed's looking at an economy that seems to have stabilized and be in reasonably good shape from an employment perspective. Has some good tailwinds. We'll summarize those in a minute. The kind of This is the one minus the unemployment rate, so the percentage employed. So we're well north of 95% employment rate now, which historically is again full employment. So it doesn't feel like you can make a good case with inflation above target, employment that's full employment, that we should be hair on fire cutting interest rates at this point. Uh, and especially when you look at the current inflation adjusted interest rate and say that it's basically zero, right? It's basically the just above zero, which is about the long run average. It's about what people would consider to be roughly a neutral rate for an inflation adjusted rate, and so therefore not have a big stimulative or restrictive effect on the economy, and ballpark about where the Fed should be. So I think it's hard with a straight face to say that we should be aggressively pursuing an easier monetary policy at this point. And it just feels like most of the things I've showed you so far suggest an economy that's normalized, and in the process of normalizing. We had this weird inverted yield curve for a long time when the Fed first raised rates. That's gone back to kind of normal. The difference between the 10-year Treasury note and the 3-month bill, the so-called term spread, is again right back at about average. So, you can think about what growth has been in the broader economy, GDP growth. It's been a little wacky in terms of the composition of growth, but overall GDP growth has been reasonably good. Had kind of a soft fourth quarter, but Q1 came in pretty strong. The Q2 and second half numbers are expected to be fairly strong for GDP growth. Um, there's some concern about the consumer strength, how durable that is. We've seen consumers continue to spend despite inflation. They're not necessarily happy about it, as I'll show you in a minute. But the current quarter data for consumer spending looks like it's going to be pretty good as well, an expectation for that to continue, and so for GDP growth to be strong. So it doesn't feel like there's a need necessarily for the Fed to provide a lot of stimulus at this point, despite again sort of the composition of GDP changing from sort of a typical composition over the last couple of quarters. And so let me kind of like the last indicator I'm going to show you does go back to this question of consumers. Um, I mean, don't tell consumers everything looks hunky-dory in the economy, right? People are upset, and especially, I would say folks that are sort of below median income households are pretty upset because the increase in gasoline prices is a real thing for them. Um, and they're unhappy about it and unhappy about broader affordability issues. And that is clearly reflected in these measures of consumer sentiment. The conference board, which is a bit of a broader measure, it's not terrible, but it's below its long run average. That's this blue line here. And the Michigan one, which loads more heavily on inflation, is just in the dumps, right? It's as bad as it's ever been, and over a very long time period. We're talking 50 plus years of data here. Consumer sentiment is as bad as it's been, and this kind of goes back to this notion of a K-shaped economy. People who have good jobs and stock market investments, they're feeling pretty good, and the household income is strong. Household wealth is strong. People who had mortgages that are locked in at 2% are pretty happy about it. But people who, are not those folks don't, benefit from the big rally in the stock market, have uncertainty around their employment, have expenditures that are affected by energy prices, by rising rents, other affordability issues. Like they're pretty unhappy. And so, how does this translate into kind of how we look at things currently versus, potentially in the future? I would say, there's this kind of list of tailwinds that include, sort of the recent income tax cuts, CapEx related to tax cuts as well, and AI investment, momentum, stock market wealth effect, and maybe some headwinds around energy inflation, maybe some softening in the labor market. Again, it's a little bit hard to tell there, and certainly things look better now. But then we start looking forward, and it's certainly possible that next year some of those tailwinds go away. We'll probably still have this growth momentum, which is a powerful effect. But if there's a hiccup in the stock market, that could be a bad thing, even though it's currently a tailwind and is likely, unless there is a big correction, to stay a tailwind. I'm not sure interest rates are going to come down much. We'll see what the Fed does, but we can take some of those things that were tailwinds and make them headwinds going forward. And there's likely going to be a reduction in capex because of the way the big beautiful bill benefits capex in the current year versus future years. These tax cuts and fiscal policy stimulus is going to fade. We're likely to see more impact from energy prices unless there's a sudden reversal and drop in oil prices, and I think these issues facing consumers are only likely to continue. So, while I would say this year looks good, I think there's an increasing concern about what might happen next year. And so, people that are thinking about planning, especially business owners, who are thinking about planning for 2027, might take a good hard look at what contingency plans would be for a weaker 2027. All right, so I probably went longer than Rob wanted me to, but happy to take a few questions and we can go past 9:30 if we need to get to some.
No, that was great. Thank you very much. A lot to cover there, and interesting looking at where we are now and where we might be in a year or so, depending on how things go. So thank you, Greg Brown, for that analysis. We have room for maybe another question or two, so you can submit it using the Q&A function at the bottom of your screen, which might be hidden behind the more symbol to the bottom right side. If you're with us by phone, you can email me. I am at rob_knapp@kenan-flagler.unc.edu. All right, first question is from Aaron at WUNC, and he is following up on, I think when you were talking about the household survey, unemployment, or unemployment, employment. He says, do you speculate that undocumented workers are likely to deny answering employment questions? You talked a little bit about that.
Yeah, I think it's a possibility. I don't have much expertise on this, honestly. I just sort of follow what other people are saying, and I mean, I think there's kind of two effects there. One is we've seen out migration from the U.S. for the first time in like forever. And so it does make sense that the labor force is smaller. I mean, undocumented workers are providing real labor to the economy. And so, to the extent that there's fewer of those, I think there's been out migration from U.S. citizens and documented non-U.S. citizens as well. Though probably most of it has been undocumented folks. So that's a real decline in the labor force and labor provided to the economy and therefore economic activity, because they're providing labor, they're also consuming things. So that's one issue. Then the second issue is like just from this mechanics of the survey, right? Are they less likely? I mean, they're just, I mean, going to be on edge because of what's happening with immigration enforcement. So they indeed may be less likely to participate in the survey, and so that gives us a skewed view in terms of how to compare recent survey results to a couple of years ago or so.
Okay.
And yeah, I mean, I would say what's been going on probably doesn't cause them to increase the chance of responding to the survey. So it's at best a
Okay.
neutral and probably a negative. Yeah.
And okay, I don't know if this is tied to the fact that every time you do the briefing, the numbers get better. And I do congratulate you for playing that card. I've been waiting for 4 years for somebody to start that argument about
Uh-huh.
when they come on and do the analysis that the economy always does better, the employment is always up. So this question is, given the data you have outlined, if you were the Fed chair and you said there's a new regime coming in, what would you do?
I would do nothing. I mean, I think the evidence right now is that it's a wait and see situation. Inflation has ticked up, but it could be transitory, right? It could be that things get resolved, and energy prices come back down, and that spike that we've seen in inflation comes back down. That if that doesn't happen, then that's a concern. The Fed needs to think about how is that going to spill over to the broader economy and potentially higher rates. But I think it's too soon to do that. But it's very hard to make a case, in my mind, to cut rates at this point, right? We're at full employment. Inflation's running a little high. Core inflation's kind of ticking up a bit. We've had good job growth. Unemployment rate, is again right at full employment. It's just really hard to think like, why would you want to provide what would increasingly be monetary stimulus to the economy, right? Things are sort of neutral right now with Fed policy, and that feels like the right place to be.
Okay. Very good. So I might ask you to take off your economist hat and put your professor hat on for a minute. There are graduates going out into the world. What have they been asking you, and what have you been telling them about the world, about the employment world right now? As I think we know from the numbers that the last couple of years have been a little tough
Yeah.
on young people, people just getting out of school. What are your conversations been like?
Yeah, I mean, I think it's very sector specific. I mean, clearly there's been a big pullback in the tech sector. Because we're here in the business school, we see a lot of people trying to go into banking and consulting as well. Those have been relatively soft. They're not as bad as they were a couple of years ago, but they're still soft compared to sort of the long run average. And again, like it's largely anecdotal at this point, but I would say I know folks, that are on recruiting teams for banks, especially because I'm a finance guy, who says, yeah, we have deliberately made a big push to AI to try to reduce the like take what was a pretty big fat base pyramid and tighten that up with AI, which that means doing less hiring at the lower end. And so you know uh, there's a debate, I think, still as to how much is sort of cyclical, just normal type stuff, and how much is related to AI. But at least anecdotally, it feels like AI is a factor. So what does that mean? That means that people need to be super tuned into how they would contribute, with AI skills in the workforce. That's true of our graduates, but it's probably just true of people in general now. It is for sure a productivity enhancer. It's here to stay. Love it or hate it, it's here. It's going to be a tool. It's going to have the same kind of impact that the personal computer had and the internet had. uh, it will be something that gets adopted and becomes a permanent fixture. It won't happen overnight. It depends on the job, depends on the industry, how what that adoption looks like. It'll be disruptive at first, just like other technology adoptions. But from a employee perspective, don't fight with AI. Make it your friend. Get good get good at using AI to be more productive and being able to convince the people that you work for or want to work for that that's the case.
Okay, great. Thank you. And AI was on your 2027 list, so that will be something to keep an eye on as we move forward. Greg Brown, thank you very much for your time and your insight. We appreciate it very much. It's always good to have you here. And Greg Brown equals more jobs. We've established that link now for people,
Uh-huh.
so they can
Yeah.
walk away remembering that. Uh, Thank you for everyone who joined us today. We appreciate you being here. For those of you in the media, if you'd like to continue the conversation with Greg or any of the rest of our experts, you can reach out to me, Rob_Knapp at Kenan-Flagler.unc.edu. For everyone in the audience, we'd love for you to drop by the website. There are a lot of new things coming soon. Remind you of our grand challenge that we're doing this year called Renegotiating Work. We continue to produce pieces on that I think you'll be interested in. We have a conference coming up very soon about the beneficial effects that private enterprise can have on wealth inequality. That's coming up in June. Information on that on the website. So a lot for you all to find. Again, I think I mentioned this. This is our fourth anniversary. We started this in May of 2022. A lot of people have contributed to the briefing in front of the camera and behind the scenes, and we say thank you to all of them for all the work we've done. It's a lot of fun. We enjoy doing it. A special thanks to Sage Pivorato from our design group who took care of the new slides that you saw today. We kind of updated things, a little less orange, a little more blue. Hope you liked it. That's what you'll be seeing from us in the future. So thanks for that, Sage. That is all for us today. We hope very much to see you first Friday in June. So put it on your calendar. We'll have invitations out soon. Thanks again for being here and enjoy the rest of your Friday.